important. And we will press play.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, sorry about that. I was testing something. Wait, where's the volume? There it is. Go away. That's so crazy. Okay, anyway. Hi, guys. I'm like, what are we doing here? Oh, yeah, I remember. Okay, last week, let's do some history. Last week, we were saying is this last week? Was last week the trade deal? Things are so crazy. It's hard to remember what happened when. That was the 15th. Holy cow. All right, so last week we were talking about the trade deal, and we talked about natural gas, and we talked about, and that's been terrible since then, we talked about the money talk portfolio, and we talked about just the stocks in the money talk portfolio. Okay, that's it. Now we're up to speed as far as like where we were in Wednesday's post. So just wanted to double check what has changed since then. Well, first of all, let's see how the money talk portfolio was at 2.7% there. See if we made any money on that. Oh, that's what we're going to do today. We're going to go over the portfolio reviews. Unless anybody, oh, nice, up about 5% in a week. That's pretty cool. Okay, so now it's up 7.7%. Obviously, we don't change anything in the money talk portfolio, but that's good. So I won't be embarrassed when I go on the show on Wednesday. So we are up 7.7% for the quarter, and that's respectable. It could be better, but we're only using the teeny tiny amount because we only started with the 3 stocks. So it's off to a slow start, as it usually is, but it's on pace to make 30% for the year, which is all I really care about. And it'll be a lot easier to make more than 30% when we have more stocks. And I wonder if we can still do our IMAX trade. How's IMAX holding up? That's one I wanted to add. I think we talked about that last week, right? IMAX, I think, went lower, which is very nice of it, actually. Yep, under 19. Very nice. Look at that. Holy crap. You know, it was here, and then it went here, and now it went here. Such a fun stock. So this is good, though. This is our buy zone for IMAX, so I'm good with that. Anything around 20, we're very happy to pick it up. And you know, it's funny because people look at this, like people think they're going to buy a stock and they look at it and it plunges and it goes lower and they're like, oh, no, I don't want to buy it now. But, you know, when you're a fundamental investor and you decide you like something, that's not really that important. And I know that always sounds weird. Even when I say it, I know it sounds weird when you say it. It's like, I don't really care if it went lower. It's just somebody's opinion of what the thing is worth. You know, at any given moment, people have an opinion of what something is worth, and it may not be your opinion. So when the public opinion is lower than what you think something is worth, then that's a good time to buy. But if you allow yourself to just believe whatever the public believes, you're not going to be able to really buy any bargains. I don't think anything happened. Look, here's 15 days ago, right? So the esports partnership. So what? Fair value of IMAX was written up by Simply Wall Street 16 days ago. I wonder what they came up with. IMAX generates record gross box office revenues in 2019. IMAX generated a record of more than 1.3 billion. I'm sorry, I'm stuck on this at the moment because it's like, it's really crazy. All right. So.
After being called one of the worst films of 2019, perhaps the new. Quiet.
Revenues of 1,035. The figure surpasses 2018 box office of 1.32. Which is not really what I call, I don't see how they think that comfortably surpass it. So basically they're in line from 2019 to 2018. They're basically in line on their revenues. I don't know what box office revenue means to them, because I think that's what they net from their partnerships. I don't think that's actually the total ticket sales. But that's all IMAX cares about. IMAX is like a franchise, okay? So they sold the franchise to the theater. The theater runs the IMAX franchise and remits money to them. Like when you look at McDonald's sales don't reflect all the sales of hamburgers in the United States and whatever. It reflects how much money McDonald's franchisees remit to the company. That's their sales. Their sales are the sales and franchise fees to the franchisers. So IMAX is in a similar situation. So it's not really telling you what you think it's telling you when you look at those numbers. But what matters is, do they make any money? All right, this is what I care about. For 2020, IMAX is expected to benefit from strong releases like James Bond. Okay, we'll give them that one. Wonder Woman, yep, that should be good. Top Gun, I don't know. Tenet, I don't know what Tenet is. It sounds familiar, but I can't remember what that is. Detective Chinatown 3. The hell is that? I don't even understand what that is. Oh well. But this is also what I care about. The top five of the top 10 grossing IMAX films in 2019 featured IMAX DNA, which means they were filmed or featured in IMAX as extended. In other words, films shot on IMAX were 1/2 of the top grossing films of the year. Okay, that's never happened before. That is a sign that IMAX is growing, not shrinking. That's a sign that IMAX is not, that there's not competition taking away from IMAX. And the thing about IMAX, see, people say, oh, what about Dolby Atmos? And what about Cinemark has an XD theater and so on and so forth. XD has nothing to do with IMAX. XD is like a high resolution digital projector. It's good, but it's not IMAX. It's not a bigger screen. It's a better resolution. It's got better sound, things like that. It's got good seats. That's what their XD experience is at Cinemark. The key thing, though, is that you've got, at this point, a generation of directors, 2 generations of directors, who have grown up with IMAX being the industry standard. The film studios have invested many, many tens of millions of dollars of IMAX in IMAX equipment, cameras, so on and so forth. IMAX is on 1,000 screens all around the world as a distribution channel. In order to match that, somebody else has to spend 10 years just building theaters, and then just to get the distribution that IMAX has, and then they have to convince directors not to shoot on IMAX, but to shoot on their new system, which will preclude them from showing at the IMAX theaters. That's just batshit crazy. Okay, that's really, really hard to make happen. And so IMAX has a really huge advantage that is not going to go away anytime soon. And China, where we've been in a trade war with China all year, they had they have 286 theaters, which is almost 50% more, scheduled to be installed by 2022. 2022 is not very far away. At this point, that's only 2 years. What else did they say? IMAX deal with South Korea, blah, blah, blah. I mean, they're, obviously constantly making deals. CVG is IMAX's partner. Who cares? IMAX Mayo. So what was the point? We were supposed to find out whether or not they liked him or not. It's a hold at Zacks. So basically they ranked it as a hold. All those words just ended up being a hold, which I don't frankly agree with. I'm like, why would you not want it? But again, we don't buy a stock because it's going to go up. We buy a stock because it's not going to go down. Because we are buying stocks for discounts using option strategies. So when I buy IMAX at $20, I'm going to sell the September, and I think we talked about this last week. I'm going to sell September 20 puts. I think September just came out, maybe. I'm going to sell September 20 puts for $1.65, let's say. And I am going to buy the September, I'm going to sell the 20s for $1.50. And I'm going to buy the 16s for less than $4, but let's say it's $4. So I'm buying the 16-20 spread for $2.50. And I'm selling the 20, did I say the 20s? No, the 19s. I'm selling the $19 puts for $1.65. So what I say here, damn it. Come on, brain. $2.50. So $2.50 minus $1.65 is nope, it's not even a dollar. It's only 80 something cents, right? Yeah, it's 85 cents. So for net 85 cents, I'm going to pick up the $4 spread. And that means now this is 19 puts. So as long as IMAX holds 19, where it is right now, we're going to make $3 on the spread and the short puts expire worthless. So $3 minus 85 cents is a profit of $2.15, which is, almost a triple. Or I'm sorry, it's 100. I'm sorry, it's 200. It's 200. It was a triple. It's 200. It's about 200% profit at 19. If it makes it to 20, make another $1. That's another 100%. So somewhere between 200 and 300% between 19 and 20 is our profit margin. If IMAX simply gets to 20, if it simply goes up $1 by September. And why wouldn't it? It's got a strong film slate. It's got things going on. Now, if you look at the valuation of IMAX, it's $1.16 billion. And we look at the earnings of IMAX. Oh, we already had that. See, I knew we talked about this last week. And you look at the earnings of IMAX, and they're going to make $67. So, basically 20, you're paying about, not 20 times earnings, 17 times earnings roughly. But look at next year. This is next year. This year's over. So we're actually into next year. $78 million profit on 1.2 billion. That's I don't know. I can't do math, but it's good. What is that? That's 1,200 divided by 78. 15. That's a PE of 15. So I'm only playing IMAX, not because I think it's going to go to 50. I just want it to stay at 19. I don't care what it does above 19, above 20. I don't make any money above 20. It can go to 5,000. I'm going to make the same money. But the same money is 300%. I don't give a crap if I could have made 400% or whatever. I just want to make my little bit of money. IMAX only has to go up 5% for me to make 300%. And that's why I love it. You guys, people say, oh, aren't there better stocks out there? Aren't there things? No, to me, a better stock is a stock that's not going to go lower. I don't care about a stock that's going to go higher. Most investors are looking at stocks and saying, I want to pick a stock that's going to go up 100%. Those stocks I could care less about because we're hedgers. We basically hedge our position. We're never going to go for 100% move in the stock price. But we don't need to because I can use an option so that a 5% move in the stock price pays me 200%. So why do I need the stock to go up 100%? That's too much work. I don't need my stocks to do that kind of work. All right. So anyway, so that got that off my chest. I guess because we talked about it last week, and it's still cheap. So it's like I still like it, and oh, I remember what it was because I didn't know when we were going to be on Money Talk. So now we're going to be on Money Talk, and it's like under the gun. So it keeps weighing on my mind because I really want to get that trade in to the Money Talk portfolio because I think it's a no-brainer. I think it's that's what's in the Money Talk portfolio. Things are so easy that I feel very comfortable buying it and not touching it for three months. So, you know, I can't touch it again until the next time we're on the show. We try not to touch things in the Money Talk portfolio ever until they just finish off. And I don't see any reason why that one's not going to return a good amount of money. And I want to keep it low risk because that's what you want to do with the portfolio you can't touch. And people a lot of times say, oh, I work and I can, you know, and I don't have time to watch things and whatever. That's what this portfolio is for. It's a very low touch, very low risk portfolio. It's a great place if you want to make, you know, 30, 40% a year. If that's comfortable for you. I'm not trying to make 100%. I'm not trying to double up or anything like that. I just want to grind out a nice little profit on a regular basis with as little risk as possible. And if you do that consistently, and I'm not going to get into the compound rate calculator again, but if you do that consistently, you will make a shitload of money. You will be all right. No, I will do it again because I don't. Not everybody's been here before, right? So, compound interest calculator. La da da. Money Chimp is my favorite. All right. So if I have $100,000, right, and I don't put any more money in, and I go 20 years, and I make 30% a year, that works out to $19 million. That's pretty good in 20 years, right? Now, obviously that doesn't really happen. That's a rarity. Now, what happens if you fall back? Let's say you have a couple of 0 years. That's going to just subtract from the total. So let's say once every 5 years you have a 0 year. So you only have 16 years of 30% growth. That drops you down to $6 million. Now, let's say you have a couple of negative years that chop some money off. Well, then call it 12. All right, and we calculate that, and now it's $2 million. Now, still $2 million, very nice return over 20 years, even if you have some drops. So what's the key? The key is not to have any years where we make nothing. The key is to have no years where we're flat. And that way, most years, if 16 of those years we make 30%, if 12 of those years we make 30%, we're still going to make a ton of money. And I'm telling you, it's a lot more money than if you gamble with $100,000 and try to double it and whatever. That's the road to ruin, because if you can double it, you can also lose it all, or you can certainly lose half. Anything you're taking that's risky enough to double your money is risky enough to lose half your money. And that goes for this entire stock market at the moment. So when I get excited about trades, it's because I'm excited about the steadiness and the surety of the trade. That's exciting to me, not that the stock is going to go rocketing higher. I look for trades where this has got to be a bottom, and if it's not a bottom, I don't mind doubling down. Okay, I can't imagine a set of circumstances in which IMAX goes down and stays down. I just can't. Could I make one up? Sure, I can make one up. Some magical thing comes along, and it's hard to say because it's so silly. You got to think of what would have to happen. The theater would have to like kick IMAX out at the end of their contract because the thing they're being offered is so much better than IMAX that they want to get rid of IMAX. And then they're going to kick IMAX out. I imagine that the theater owns the box that the show is in. Maybe IMAX owns the screen, and maybe IMAX owns the projector, and IMAX owns the sound system. But I imagine the theater owns the seats and the box that it's in. So then some other company comes along, the Chinamax company comes along with their cheaper system, and that becomes a standard, and they push that in. Then IMAX, possibly goes out of business. Outside of that, though, is the Chinamax company going to come along and every theater that has IMAX or theaters that haven't got IMAX so far start building Chinamax systems? And then filmmakers, and then Chinamax, let's say, gives their equipment for free to all the Hollywood directors, And even though they might not like it as much, the studios insist that they use the free stuff instead of the expensive stuff. Yeah, that could happen, I guess. I mean, that could happen in any industry, though. I mean, you say that about Tesla. Somebody can come along and make a better electric car and give it away. Sure. You know, I mean, obviously that could happen. Whether it's realistic or not is a different question. Logically, it's very difficult to replicate what IMAX has done. They have to go to all these theaters. They have to get the theater owner to commit to a very large project of probably knocking down 2 or 3 theaters together and raising the ceiling and doing all kinds of stuff just to accommodate their gigantic system. In fact, you see a lot of places IMAX is sort of dug into a pit in the bottom. That's because some theaters just couldn't possibly raise their ceiling, so they had to go the other way. They had to dig into the floors to make an IMAX theater. But meanwhile, it's always a big project to do it. There's a lot wrapped up in it. IMAX has a huge brand name. The Hollywood people love them. When they're making $1 billion picture, they go to IMAX to shoot things on IMAX. That's the go-to company. There are films right now committed, obviously. Films shoot on 3-year cycles. So there are films right now committed 3 years from now that are going to be using IMAX, big blockbuster, huge films. You have to, just to start getting to that cycle, you're talking like 3-4 years out before another company can even begin to get in that cycle. And like I said, without the market share and such, how are they going to really do that? How are they going to actually get these companies to commit if they don't know that they're going to be able to show the film? Who's going to shoot a $500 million? If you have a $300 million budget to shoot the Avengers 5 or whatever the hell they're up to now, and you're going to spend it and you're going to bring in IMAX equipment because your last Avengers movie did $1 billion on, with IMAX and other theaters, but it was shot in IMAX, so that's why people loved it. Now you're going to go and turn around and say, okay, I'm going to go with Chinamax instead for the next one, and we'll just hope they have the theaters lined up by then. That's an impossibility. So now you're saying, okay, well, the theaters, you have to first of all convince the theaters to do it. Then they have to go through a year plus a cycle of like closing their theaters down and redoing it and so on and so forth to make a Chinamax theater space. Meanwhile, they lose the revenues and so on and so forth. It's just so unworkable, which is what makes it a great investment. And another thing that makes IMAX a great investment, though, for us especially, because we sell calls and things along the way, is because IMAX is in a very predictable long-term channel. Nope, wrong there. Okay. So IMAX is in a nice, predictable long-term channel that basically goes by whatever people think the box office is. Now, I just read the 2020, and it started off good, and then I went, oh, it petered out fast as far as like, well, what the hell are those movies? Oh, come on, work. Yahoo has become so horrifyingly slow, it's useless. Seriously? No, you have to shut it down. It's something they did to make it interactive, makes it clog up. Not profile, chart. Chart. Okay. Are we even on IMAX? Here we are. Okay. So as you can see, predictable high 25, predictable low around 19. That's going back to 2017. And money-wise, as we saw before, in 2017, they made, well, going to 2017 was actually a bad year, but they made in 2016 $28 million, then they made $2 million, then $22 million, $30 million. You know why? Because IMAX goes through investment cycles, and this is what happened here. The investors didn't like it. They were making $50 million in 2015. Well, that's not the long-term chart. 5 years. Okay, so in 2015, they were making $50 million, and people thought they were growing very fast. They were like 40, then they jumped to 55, and people were extrapolating all kinds of money. But IMAX said, no, we need more theaters. We need to invest. And so they took the money, and instead of dropping to the profit, they reinvested and built up, and they doubled in size. Now they expect to get to $100 million. But because the chart looks like this, and most investors are chart readers, because the chart looks like this, nobody thinks that what they did makes sense, because they're a cyclical company and they've just spent a lot of money in an investment cycle. And now they're going to reap the benefits of the investment cycle. But another reason cyclical companies, though, will tend to stay low is because an investor goes, well, yes, so what? So they made $100 million this year. Let's say 2021, they make $100 million. They're going to go, they're only going to go and spend and go back to 50 million next year. They're only going to start spending money again for the next cycle to invest. And that's true. That's what cyclical companies do. They expand, they invest, they grow, they expand, they invest, they grow. And over the long haul, they make more money now than they used to, like Exxon, for example, right? They go up, they go down, they go up, they go down. But meanwhile, now they're $1 trillion company, whereas 20 years ago they were $100 billion company. So along the way, and here, let's take a look at Exxon. XOM. So here's Exxon. What the hell is that? That's weird. Changes styles. So look, so along the way, they've steadily gone up if you've got the patience for it, right? But if you look at it, if you look at them over a period of time, that's pretty freaking erratic, right? That doesn't look exciting. That doesn't look exciting. These are 5-year chunks. That doesn't look exciting. That doesn't look exciting. It was exciting back in 2000 whatever, but it hasn't been exciting since. But if you look at a long-term chart and say, well, gosh, this is a great freaking company to put $1.65 into, isn't it? Because, by the way, that's not the end of the chart. So, you know, you put $1.65 into it, or what is this, $3.50 back in 1983, and here we are 40 years later at $90 or whatever. Oh, no, sorry, $67. It went back down. But at some point you got to 100. It's going to get to 100 again. But you got to be able to be patient. It'll probably get to 500 at some point. I mean, assuming they invest properly. Oh, there's my next topic. Total. Well, should do one thing at a time, shouldn't I? Total. We were just looking at in chat. That's today. Okay. So Total, I guess, because they're French. Jean-Luc would know. Let's see. Where's my page down button on this thing? There it is. All right. So I got the teeny tiny little keys on this thing. So we just were talking about that, so it must be down at the bottom. Okay. So here's what I read in the news. So Total, they win a contract in the Netherlands. Okay, remember the Netherlands, like Amsterdam. So in the Netherlands, they are going to install 20,000 EV charging points. Now, charging point is for each car. A charging station is a place where charging points are. So in just this little country with 17 million people, they're going to install 20,000 charging points, and that's only in 3 counties in that country. So in other words, in about 20% of the country, there's 3 counties, or whatever you call them, provinces, that will have this coverage. That's all this award is for. If you read deeper into it, that's what it really is. So in 3 provinces in the Netherlands, not for the whole Netherlands, but in 3 provinces that they believe will cover 3.2 million people, they are installing 20,000 charging points. Tesla, which is now approaching $600 a share, has 15,000 charging points, 1,800 sites, so about 10 chargers per site. They have 1,800 charging stations, not all superchargers, only about 500 of them are superchargers. I don't know whether it's the Totals are superchargers, but they probably are, because they're essentially installing them in all their gas stations. So that basically when you see a gas station, that's Total, you know that it's also an EV station. You can just pull up in there and get a charge. But logistically, it wouldn't make sense for them to have you have to pull up there and leave your car for 8 hours. So I'm assuming those are what you call supercharging stations that will charge an electric car in a half hour. So whether it is or it isn't, though, it's in line with Tesla. But the point being, this is what Tesla has for the entire United States, 15,000. These guys are installing in part of the Netherlands, 20,000 points. And then the statement that they made after that is what caught my eye. Excuse me. The thing after that is what caught my eye. And that's that they want to operate 150,000 charging points in Europe by 2025. That's 10 times more than Tesla has in America now. This one company, Total, is going to put in within 21, you count 2020. So within 3 years, if we count 2020 and 2022, obviously. Oh no, I'm sorry, 3 years. I'm thinking it's 2022. I'm sorry, it's 2025. So in 5 years, they intend to have 150,000, 10 times more charging points than Tesla. And effectively what they're saying is wherever we have a gas station, we want to have electric vehicles be able to pull up and charge. That's going to be our brand. I think going by what I'm reading in Davos, and I always read all my dispatches from Davos because a lot of stuff gets decided there. That's where the rich people are. So the people who actually run the world are basically hanging out at Davos right now. Before they go to Bilderberg, where they really make decisions, they're at Davos. But the purpose of Davos is so the people who run the world can sit down with all the CEOs and say what's what. So another thing I read was this, and this is just one of the things, but I mean, this is just something. I've read several things in this nature because about half of Davos right now is all about global warming. They are actually getting concerned. Even the rich people are concerned because you can't really bunker your way out of this. If it was a nuclear war, they would be very happy to go into their underground bunkers and sit there for 10 years eating rations and then come out and own the world. That doesn't bother people at all. What bothers people, though, is the death of the entire planet is something they consider a negative, because Elon Musk has so far been unable to get them off the planet. Once they can leave the planet, then we're on our own. But right now they're stuck with us, so we're going to be able to at least count on a little bit of support from the uber wealthy people. So the CEOs are debating, as in they say, "Oh my God, no way." What's being proposed to the oil companies, including Total, is to say, you guys are going to have to be responsible for what your customers are doing. In other words, so far, all that's being done with the oil companies has been to say to them, you have to stop causing CO2. But it hasn't been meaning that you can't deliver oil to people. They've been saying that you in your operations, and anybody who's been in Texas, where all the refineries are around Houston and stuff like that, what a refinery's place looks like. I mean, it's unbelievable. You can smell it from 50 miles away, and you can see the smoke everywhere all the time. And that's just being pumped into the atmosphere all day and all night. And it's not, and that just happens to be our little pollution heaven in America. There's something like that in almost every country in the world. And that's, responsible for a huge percentage of the world's total pollution. So they've been on their case to clean up their own operations and clean up the coal companies and so on and so forth. Anybody who's got the interest in this, that's already a given. But now they turn to them and saying, this isn't enough. Now they're saying the second biggest problem in the world is that you're selling carbon fuels that are responsible for most of the greenhouse gas. They're like, it doesn't matter if you have a zero carbon footprint, your customers are killing the planet. And they're saying you have to stop. So Total is already saying, that's right, we're going to phase into becoming an energy station. You stop by and get your cup of gasoline, you get your cup of electricity and put it in the car. And you'll pay for that instead. So you'll pay for that electricity instead of whatever. And that's fair. I mean, electricity is not free. And it's actually kind of a problem that Tesla's done. The way they started it by giving you free fill-ups, basically, is they've sort of created this myth that if you have an electric car, you pay zero for refills. But that's not the way it works. I mean, somebody's paying something for it. You know, you have an electric bill at home, you're paying to fill up your electric car. It might be less money than gasoline, but it's certainly not free. I think as a rule of thumb, it's generally about a third of the cost of gasoline, but it's not zero. So, you know, a lot of people sell you these electric cars and say you're going to pay nothing and you don't have to pay anything for gasoline anymore. It's like, yeah, sure. And that's true. See, that's the trick of the advertising, because they say, oh, and you'll save this much money on gasoline. That's true. You won't buy any gasoline, but you will buy electricity. So you're not saving what you think you're saving when you get an electric car. You're saving about 2/3 of what you think you're going to save. And it's nitpicky, but it's not, because it really does matter to people, and it's very dishonest. So, and there's a carbon cost to that, depending on where your electricity comes from. There's a carbon cost to that. Now, the Netherlands already said you have to be in carbon neutral. Your source of electricity has to be carbon neutral, or what's the point? So, meanwhile, what is that saying? I like Total because they're actually doing something. This is a big, huge project. They're spending a ton of money. They're huge. They're like the Exxon of Europe. If you don't, you know, they're a really huge energy company, gasoline company, everything. So it's great that they're doing that. I like them, and I've always liked the company in general, and they're not very expensive. Oh, we already did that. Okay, so here's Total over many years, and as you can see, again, it's like Exxon, and they happen to be in a bit of a trough. So it's kind of a good time to invest in them. So they're now on my radar as somebody I might want to start putting into our long-term portfolio. The problem is that with all these fossil fuel companies is they have a very, very tough transition ahead of them. And it could go very up and down. But as you can see, these guys are like a juggernaut. Look at these revenues. They were well, this is when gas was real expensive, but then they were 143, 127, 143, 184, 180, 200, 200. Profits are 11 billion, 13 billion, and you can buy the whole company for $138 billion, 10 times earnings. Why is that? Because people are worried it's going to go back to 5. But you know what? Even if it goes back to 5, that's not tragic. It's 20 times earnings in a trough, in a disaster. It's 20. They still made 20 times. You know, they're still doing 20 times earnings. And so I think they're going to have a rough transition. They're going to get through it. And I think that what I would start with Total is saying, well, how much can we sell some puts in Total for in a long-term portfolio? So we go Total. And oh, nope, there's the problem with them. That's why we don't play them. They only go out to August, so it's kind of annoying. IMAX does too, but IMAX is a little stock and I don't mind. But only to August. It's very hard to predict what's going to happen between now and August. But that still wouldn't stop me from, let's say, would I buy Total for 48 bucks? Sure, 48 bucks is a good price. So I'm happy to buy them for 48 bucks. That means I don't mind selling 10 of these puts for $1.75. That's going to bring me in at 48.25. That's only by August. So I'll sell. That's about 1/3 of a 2-year cycle. So if over three sales in the next 2 years, I'm going to sell 175 plus 175 is 350, and then 425, 525. I'm going to sell 525. I'm going to sell 10% of the stock price in 2 years to stake out a position in Total. And maybe we'll never actually get it for that cheap, and maybe that won't happen. But at least we're going to pick up some cash along the way. That's all. So pick up $5,000 on some sales. I like them for initiating position, but because they don't have long-term options, that's why we don't play them. So now I remember, after wasting a lot of time looking at them. But we would play them more often, except for the fact that they're cheap, and over this period of time, there's absolutely no way to predict the movement of this stock. It could do anything between now and then. How's the whole market doing? Oil disaster. Wow. Under 57. RB 158. Natural gas back to 190. I knew I should have taken the money. See? What is this length of time? These charts are crazy. Days. 5 day, 5 minute. That's better. Anyway, when it was up here before earlier, I said I should have taken the money. I didn't. I left it on. So my freaking So annoyed. Trade, active, 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 NQ, YM. We're out of these things at the moment. Oh, look, NQ's. I'm not dying to play the futures. Oh, that's oh, I am short on the NASDAQ. What do you know? So I got the NASDAQ short, but that's the only one left, I think. Oh, no, wait. No, it's position flat 0. Oh, no, so no, we're out of that too. Okay. So these were the three things from this morning. Oh, here's NG. Look at that. Down $2,200 again. Shit. So stupid. I wasn't watching. That's because I was busy. I could have sold it right there and been close to even. See, our break even is 196. Oh, well. Anyhow, let's see if there's any questions. No questions? You guys, no question. Last time you asked, everybody asked questions at the last 5 minutes. Don't do that again. I'm not falling for that twice. What time is it? 1:45. Okay. So where were we? Yes, I remember what I was doing. So position portfolios. So this is going well, Hempoker. It's and nothing particularly great. And gold is kind of flat to where we came in, but it's above our target. That's what I mean, though. By the way, that's a nice thing. We didn't take a bullish position on gold. We just bet it would hold 17. And because of that, we're making money, even though the stock's going nowhere since we came in November. IBM is also well, IBM's doing pretty good. They just had nice earnings. They're up $4 today, so they're bang on track for a full amount. That's last year's trade of the year. This is this year's trade of the year, and this is SunPower. These are not updated, so there's not much point in really going over them at the moment. Butterfly portfolio, 87%. Let's see, we did a review. Oh, wait, let's get back on track. Okay, so that came up for whatever reason. Oh yeah, I remember what I was doing. Haha, that was clever. Okay, so look, if we're doing it right, our strategy is really boring, okay? Really, really, really boring, because look, let's go back to Hempoker. No, not Hempoker. Oh, 10%, that's pretty good. Where were we? About the Money Talk. 8%. Did that just go up? That's weird. This is a boring strategy. Here's gold, in case you don't know. Gold is Barrick gold, not the substance gold, although they're pretty much right in line with each other. So here's gold. We came in November. They're up $1 since November. Nothing very exciting has happened. But from an excitement standpoint, we paid 15.6 minus 14.9 is not very much. 14. Let's see. Let's try again. 14.9 to 15.6 is like $700, right? So we paid like net $700 for this spread, and the spread is now, let's say those two cancel out, so now it's $3,000. Now it's up 5 times, or it's up 4 times. It's 5 times what it started with. Nothing happened. And again, that's going back to, this is why I like IMAX. So when I say, oh, I love IMAX for the same reason that this was our stock of the year. I have an incredibly high degree of confidence that I can make that same kind of trade with IMAX. And don't forget, by the way, the 200% payoff in IMAX is only for 6 months. It's for, was it September? It's only until September. It's not even a full year. This is a 2022 spread. IMAX, we're going to do it and do it again and do it again over 2 years. It'll be 3 times 200% or 300%, not once. So it actually does work out to be as good or better than the gold trade, except you just have to be a little bit more active in it. But if I have that degree of confidence and I'm going to make that much money, why wouldn't I do it? That's what this is all about. And it should be boring. I've got nothing to do. I have nothing to do here at all until 2022 when I cash out. I have nothing to do here until 2022 when I cash out. 2022, cash out. That's it. I'm done. I tied up my money. Obviously, we have a lot of cash left to spend, but I mean, we used only 8,000 in margin so far. But I tied up my money when it's full, like the dividend portfolio is full. We have in the dividend portfolio, we have absolutely nothing to do. It's up a ridiculous 28% already. We filled this portfolio. Look, negative cash, negative buying power. This is because this is portfolio margin. No, I'm sorry. This is IRA margin that this thing shows. So it shows minus 57. But minus 57 means out of 200,000, we only have 43,000 left in buying power. So we're done. This portfolio is completely full. We used up all of our cash. We ate into the margin, and we only have a little bit of margin buying power left. That's it. So this is a full dividend portfolio, and we decided what we're going to do is not touch it again for 2 years. Why are we not going to touch it for 2 years? Well, not all 2 years, because some of them, this one expires. Everyone else is 2 years. But why are we doing this? To show you that you can. To say, look, we're going to make some good money. This thing made 28%. We haven't changed a freaking thing. And we only started this portfolio in October 25th. So in the first quarter, it's up 28% with a bunch of unbelievably boring dividend plays. And these dividend plays, to give you an example, AT&T, we bought AT&T for $36. That's the buy price. We sold the $35 calls. We sold calls lower than the buying price. So all AT&T had to do was not go down, and we would make our money. We sold the $30 puts, so we said, well, so what are we saying here? We buy AT&T for $36. We sell the calls for $460. So I'll say that's 37. So 37 minus 460 is 33, minus 60 is 32.40. So we buy AT&T for net 32.40, and we are going to get called away at 35 bucks. That's with a 260 profit basically on that. So I know that my net at 35 is 260 or 33.40 is my net price. So now I'm selling also some 30 puts. So what I'm saying is I'm happy to double down because these are going to cost me, these cost me 33.40 for this 1,000 shares. And if I have to buy another 1,000 shares at 30, my average is going to be like 31.50 or something like that. So, and I'm happy to own 2,000 shares of AT&T at 31.50. Now, in reality, that would become a margin problem. This is our biggest position, I think, in the portfolio. I'm pretty sure it is. Yeah. So this would be our biggest position in the portfolio. Macy's is pretty big too. But so we would have to sell something or do something else. But we're not really planning on it. Meanwhile, AT&T is at 39 bucks now, so we're in good shape. But the bottom line is it seems like a really boring play, right? You're not going to make much money. The reason we're in these is for the dividends. AT&T paid us $520 already for the first payment, which came on January 13th. So we're going to make another $2,000 this year in payments and another $2,000 next year in payments. So now it's not just $2,500 if we get called away at 35. It's $2,500 plus $4,000. So $6,500 against our net 3,200 entry is now 20%. So suddenly, oh, that's actually kind of interesting. Plus we sold the puts, so now we're bringing it up to like $8,000, almost $9,000. So now this little stupid AT&T position where we can't even make money above $35 is paying us 30% for this ridiculously conservative play. And that's what this is all about. That's what this dividend portfolio is all about. In a very odd set of circumstances, though, things have gone up so much in this portfolio, I almost would be tempted to cash it out. We're not supposed to make that much money this quickly. That's a crazy amount of money to make so fast. But, I'm going to leave it because it's an experiment and there's no skin off my back to just leave it and see what happens. But the potential for this portfolio is only about 60% over 2 years, maybe 70. So this is a way too much money to make this soon. Then we've got Tangier Factory Outlet. I think I totaled it up at some point. Maybe I didn't know. If we didn't, I have to. Then we got Tangier Family Outlet. We bought that for $17. We sold the $15 calls, way below where we bought it. It's now at $16.63. I don't care that it went down. I sold the $15 calls. We'll buy more if it gets below 15. Signet Jewelers, same thing, $16.95. Now it took off. It's $27 now. That's crazy. There's definitely a case for cashing this one out. This thing went nuts. But also, meanwhile, it's paying a dividend. It pays $370 while we wait. It's free money, just boom, comes in every quarter. And most of them, let's say the average here is 350. We have 9 positions paying us $350 a quarter. That's like about $3,000 a quarter that we're collecting. That's $12,000 a year just from this portfolio. It's only a $100,000 portfolio. We're collecting $12,000 just in dividends, and then we make money on the stocks in ridiculously safe fashion. I mean, obviously nothing's really safe. The whole market could collapse. We bought Annaly for $8.92. We sold the $7 calls. We bought Altria for $46. We sold the $47 calls. Oh, we were super aggressive there, right? But it's already at 51. We bought Macy's for $15. It's at $17, but we sold the $15 calls. Ford, we bought at $8.68. We sold the $7 calls. Now it's at $9. Energy Transfer, we bought it for $11. We sold the $12 calls. That was very aggressive. It's at $12.86. I mean, it's aggressive for us. So in other words, we sold calls that were $1 higher than the current price of the stock. That is the most aggressive thing we did in this whole portfolio, that we bet that this thing would make $1, 90 cents. China Telecom, we bought the stock for $39 and we sold the $37.50 calls. You see the pattern? Safe, conservative, simple plays that you don't have to touch for 2 entire years, and they're going to make 30% a year. You got to go back and analyze your actual trading and say, do I do better than that? You know, sitting here staring at a screen and watching these freaking dots go up and down and looking at all this crap, do you do better than 30% a year every year consistently? Because if you don't, maybe you should start thinking about this stuff. Oh, here's natural gas coming up again. All right, I like to gamble too. I got 4 long natural gas contracts. Look at these things, okay? I'm gambling, but I gamble with the profit, with a tiny part of the profits from the portfolios. I know I'm going to get $12,000 in dividends this year, so I have $12,000, and I don't need it to live. So I basically can say that's my funny money. I can take that $12,000 and play around with futures contracts. And if I lose $12,000, stop playing the futures, wait till next year in 2021, I get another $12,000, and I can start playing the futures again. If I make money in the futures, great. But and this is what all gamblers do wrong. If you lose your money, stop. You know, I'm a well-off guy, but my rule in poker is I go to a poker table with $500. That's not true. I mean, I have more. I mean, intentionally $500. I go to the money machine. I'll take $500 out of the thing and go to a poker table. That $500 is like my vacation spending money when I'm doing. I'm usually away, even though I have a casino near me. I don't really go, but I'll go to play poker. And I'll take $500 and I'll sit at the table. But I don't use $500. I buy $200 worth of chips. And my rule is generally, if I lose that $200, I'm done. That's it. Boom. Okay, that's my poker budget. Gone. And if and for me, it's like my poker budget for the month or whatever. If I'm in Vegas, it'll be for the day. I'll go each day. I'll take $500. But if I lose 200, I walk away from the table and I come back later and then I can go another 200 or something like that. But only twice a day is the most. You know, and sometimes, I'm sorry, the reason I might have 500, the reason I take 500 though, sometimes I can't play the 1-2 tables that I like to play. And if I'm playing a 2-5, I need more money. But generally I like to play the 1-2 table. I like to play $200 because you know what? I lose my $200 plenty of times. Happens, right? But occasionally, let's say 40% of the time I get wiped out. 40% of the time, 30 something percent of the time. The other another 30 to 40% of the time, I'll make a little bit of money. I'll break even. I'll lose a little bit of money, somewhere in that range, but just generally wishy-washy. one time out of 10, I'll make $1,000 or $2,000. I'll make 500 or more, put it that way. At least 500 or more. I might make 1,000. I've made 2,000. I've made, most I made it one sitting in a 1-2 table is about $2,500. So again, my reward is so much higher than my risk, but only because I have a discipline that keeps me from losing too much money. I'm only risking $200 per session that I'll sit down. I can make $2,000 in a good session. I'm generally going to break even 8 out of 10 times. They'll wash each other out. I'll lose 200, I'll win 200, whatever. I'll break even, and 1 or 2 of those times I'll have a nice win. I'll take a big stack. But also that depends on knowing when to quit. So like as soon as I win $500, I'm like, boom, that's it. I guard that $500 in my life. I might play $100 worth of that 5, probably not even though, on bets. So I'm like, basically, the other players at the table don't know it, but I'm playing now. Once I have $500 and I've doubled my $200 for sure, and I got $400, I'll take $100 and I'll gamble with that. But as soon as I lose that 100, people think I'm going to go all in on something and they'll bet something. I'm like, no, I can't afford that. Like, what do you mean you got $500? I'm like, no, not really. Because I'm no longer playing with 500. It's on the table, but in my mind, that's banked. And I'm not going to play it under any circumstances. And I start playing like I have $100 because I doubled my money. What kind of idiot would risk that? You double your money, you protect it. If I'm so good at poker that after I double my money, if I'm so great, then I should be able to double the 100 and get 200 back real fast, right? Turns out I'm not that great. Turns out that it's just as easy to lose the next rounds as it is to win. You got to be the same with your stock plays. It's about money management. In fact, look at the futures here. $500 profit, $650 profit. That one's been losing for days. $375 profit. I took those off the table. One of the reasons I took those off the table very quickly is because I'm trying to make this money back. I don't have the right to risk this. So when I made some quick money, I took it off the table and I said, great, boom, done. Now I've made up a large amount of this. That means I can let this ride without having without being freaking out about how much money I'm losing on that one. God damn, it went to the same price again. That's where I shorted it twice before, 29.40. Damn it. Okay, well, so there was another opportunity to short, but we didn't take it. But you've got to play these things, and you have to take the money off the table. And obviously, I gamble much bigger than that. But you've got to take these things off the table. Otherwise, you can't win. If you're not going to be satisfied with winning, you can get wiped out. That forces you to stop playing. You lose all your money, you're forced to stop playing, right? But if you win and double your money and you don't stop playing, that means you're only going to really stop when you're wiped out. That means you can't win. That means the game is pointless. You're not happy when you win. You get wiped out and you lose. The only thing that's going to happen to you is you'll eventually get wiped out if you keep going. You have to learn money discipline strategies. You have to manage your money is more important than actually winning. With the futures trades, the way we do it, it's like you don't have to be right all the time. You just have to be right and win bigger when you're right than what you lose. You have to control your losses and make a bigger win. Now, this is an exception. This is what I call a conviction play, because I went over this with the members. We were talking about it last week. I don't care if gas, at this point, the average is 196. If it goes to 180 and I get 2 more, it's going to knock 8 cents off and I'll be down to 188 at 180. On 6 longs, though, that's a pretty big loss. It's still going to be, it's like an $800 per contract loss on 6. So at 180, we'll be down $4,800 when I double down. But I'm willing to carry a $20,000+ loss on natural gas, because if I have that kind of loss, I'll have 12 contracts or something like that. And if it ever does turn around, I can make $100,000, $200,000. So I'm willing to take that bet and ride it out. But you have to be careful. And when it hits 196, though, I'm absolutely going. In fact, I said when it hits 195, it didn't get to 195 today. If it hits 195, I'm absolutely going to go back to 2 contracts, and I'll have a small loss, very small loss, and I'll have 2 contracts, and they will go back to where I started, because that way, if it goes back down to 180 again, I will be thrilled to double down and have 4, because then my doubling down will have a much greater effect. And instead of averaging 196, I'll average 183. No, that doesn't make any sense. It would be 8, 16. If we do 2 contracts of 80, 16, 8. Whatever splits the middle. So be it'll be one. Okay, that would be 188. Then we'd be down to 188. So I would love to do that. So in other words, it'd be great. What I would love to see happen is go back to 195, cash out, go back to 180, then buy 2 more. Then I have 4 at a lower price. But that's I don't play a lot of things with conviction. Mostly I'm like $500, thank you very much. $500, thank you very much, done. Because look, even while I'm talking, they reverse constantly. They go up, they go down, they go sideways. That's fine, but if you're not going to take the money out when it goes up, what the hell are you doing? What kind of game are you playing? I stop out here and lose, but when it goes here, I don't take the money. If your stop is lower than the amount you take off for a win, that makes no sense. Especially when you lose something, you got to get it back and get back to 0. Then you start again. Then find a clever play. But you've got to have a discipline for money management. That's the key to this whole thing. Because you can be right, you can be wrong, you never know. But as long as you lose less money when you're wrong than you win when you're right, you can do very well. Let's see. Theo says, I have 5 short calls on Tesla, 3 in March, 1 in April, 1 in July, but running out of margin as the stock keeps going up. Any recommendations on what to do? As I don't want to book the loss now and wait for a pullback, hopefully, is it possible to protect my margin without taking too big of a loss by closing the position? Well, you say closing. Are we talking about rolling? Because that matters. Is this you again? I prefer to wait for a pullback. Maybe this is a bad move. Well, it's been a bad move, right? We're getting killed on Tesla in a position too, because it's just goes up and up and up, and we're at this point just trying to be patient. And it's crazy because this is an insane move. Look, what the frick, Tesla? Oh, dyslexia. Okay, so it doesn't matter what you have, but let's take another look. Let me see if I can figure this out. Tesla. 5 short calls on Tesla, March, April, July. Okay, so I'm just picking an arbitrary thing in April because it's not. I'm not silly to discuss every single possible thing you could have. Wow, that's a lot of strikes. Okay, so let's say you have 5 April 500 short calls, and they're $115. Okay, with Tesla at 585. Well, first of all, Tesla's at 585. These are 115. They should be $85 if it closed today, right? So therefore, $25. I know 85. Sorry, $30. $30 of it is premium. So your loss is obviously $30 less than it is now. You're being killed on margin though. There's a couple of things you can do. Thing number 1 is you can sell without changing it. If you just want to try to make back a portion of what you got, let's say you just want to cut your losses a bit. Okay, the premium's going to wear out. You could sell the 550 puts for $50. What is that going to do to you? Okay, if you sell the 550 puts for $50, you have now given yourself a $50 cushion, obviously, to the upside here. You've also collected $50. So you're going to make $30 back when the premium wears out. You're going to make $50 if it stays up here. You're going to make $50 back on the short calls, and that takes your loss down by obviously $50. You know, and actually would be, your loss would be $80 lower because the premium wears out here for 30 and the short puts expire for 50, right? So that's $80 of your current apparent loss would disappear if Tesla finishes at 585. And obviously, no matter what it is, you're still losing 80 less than you would have. That's the key to it. Because if you cash out now, you would lose that money. This will also greatly reduce your margin. It should reduce your margin by $50. You sell these for $50, your margin should be $50 lower. That'll take some of the pressure off. You know, you're saying I don't want to book the loss. That's a weird thing. That's a real preference thing. So if you know, I'm trying to avoid rolling, which I would do. With more freedom. Oh, and by the way, so when Tesla, you have the $550 puts and you have the $500 calls. And again, this is just an example. One of them is going to win and one of them is going to lose. They can't both lose. Right? Well, they could both. Actually, if they both lose, that's well, yeah, they could both lose because you can be in between the two. You could be at 575 and you'd owe $25 each, but that's $50, which is way better than you are now. So that'd be fine. And all you're going to do in either case, though, is whichever one you owe money to, you're just going to roll them out to longer calls at wider strikes. So in other words, at $50 in July, you've got the 515 puts. And at $115 in July, you've got the, well, it wouldn't be 550 though, it would be 80 something because like I said, you know, the premium will wear out. You'd be at 580. So you see what's going to happen is that these guys would go down to 515 and these guys would go up to 580. And see how you're moving the spread. So then the next 3 months, you go to 6 something and these go down to 450. You just keep rolling them along until you finally end up in between the two and they both expire worthless and you're done. So that's the way to salvage it without investing more money, and it also cuts down your margin because you're selling the puts and you're selling the calls and you keep pushing them out in time and strike, and eventually Tesla settles down and comes in wherever you targeted it. So that's one way to fix it. Another way to fix it, though, if you could roll them, then I would probably sell, I guess I would sell the July, I hate to do the 500s. I think they could go lower. All right, let's say for argument's sake, though, you sell the July 485s for $40, okay? So you sell the 45 puts for $40. That's going to lower your margin by $40 because obviously it's not possible for both of them to happen at the same time. Then you take your calls, and let's say they are $115. You roll your calls to, you know, 535. That's all you can get. Oh, I'm sorry. You apply the $30. I'm sorry. How much are we going to get? $40. Sorry. You apply the $40 that you're collecting here to the 115 that you currently have charged against your calls, and that makes 75, right? So now you roll to whatever 75. So then you roll to the July 610s. So now you have the July 610 and the 450 puts, and you've already created that target that I was just talking about rolling to. So in other words, instead of going into April and doing it there and waiting for April and seeing what happens, you're just going to right away go to July. And what that's going to do is drastically reduce your margin. You'll take the loss, obviously, initially. It's going to drastically reduce your margin because now you're going to be in a much wider spread where you're balanced. You're in a much higher strike and you're balanced. So those are the two best ways to kind of try to fix it. But you know, and also though, at that point, you've got to put stops on your short calls. You should always have that anyway. You can't let yourself get in a situation like that if you can't afford the margin. Any time that if you're going to roll or double down and do anything with a position, if you're going to move into a position that you cannot roll and double down again, don't go to that position. Find another way. You need to address that problem before you make the move, not after you make the move. You have to be able to do what I'm talking about now easily before you do it. Now, Tesla is an insane runaway stock. Normally, I would say, frick it, just roll to 10 of these up here at $40. Instead of spending 75 on those, you can go to 10 of the frickin' 720s and let's see those bastards get there. I can't say that against this chart. I can no longer say that. This is a runaway stock. As unlikely and as ridiculous as that would be, you have people slapping $1,000 price targets on these guys now. I think it's bullshit. I think in earnings, they're going to be back at 450. That's what I think is going to happen. And you know who just did that? Fuel Cell. There you go. That's what happens. They went from 50 cents to 250, just like Tesla. Boom, 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 right? And now, and they went down a little bit, and they consolidated, went up, and everybody's like, oh, they're going to the moon. But earnings came out, and they lost a third of their value, basically. Why? Because it's reality. Because now there's an actual number associated with the earnings. You know, Musk is a multi-billionaire. He can pay off all these analysts, and he can have all his friends pull strings, and all his media buddies put pressure on people to write something. And by the way, I say you have to pay off an analyst. You don't have to pay off an analyst. Here's what you do. You call Jeff Bezos at the Washington Post, and you say, hey, Jeff, I want you to do me a favor, put in a positive article on Tesla. Now, Jeff Bezos doesn't go to a reporter, get me a positive article on Tesla right now. That's not how you do it. The way you do it is you ask 5 people to write articles on Tesla, and you reject anything but the most positive article that's submitted to you. This is what editors do all the time. They say, give us an article on Tesla. I submit things to Seeking Alpha. This happens all the time to me too. They want a certain take on a company, and they reject a take they don't like. All right. Now, I'm not going to say they were paid off, even though there were already scandals involving people alleging they were paid off. I don't know that still happens over there. I just know that there was a big scandal where it did happen over there. I think that scandal hopefully taught them how to be a lot more subtle about it. But the way you be subtle about it when you're and this works whether you're a publisher or whether you're an analyst, because if you're the analyst company and you want a positive report on Amazon for your pal Jeff Bezos, who just did you a solid on something else, what do? All you have to do is say, hey, you 3 analysts, give me your reports on Tesla, okay? And I'm going to take them, and I'm going to read them, and then I'm going to take the one I like the best, the one that tells the story I like, and I'm going to give so in other words, and they can even get the idea. Those analysts aren't stupid. They know what you're looking for, but you don't say it. You just ask 3 different analysts to give you a report on Tesla, and they all bust their butt trying to give you the most positive, because they know that the last 5 quarters, the most positive report on Tesla has been the one you paid for and used. So those analysts are going to be like, okay, this guy wants the most positive report on Tesla I can write. So they're competing with each other in the office to write the most ridiculous overpriced stock target and all that. So when I say Elon Musk is pulling a string, it doesn't mean Elon Musk is going to each individual analyst and saying this and that. It just means Elon Musk has to call his buddy at the rating service who he pays to do ratings, who he's got contracts with. And obviously also members of the same golf clubs and things like that. And he picks up the phone and says, hey, buddy, you know, could you get me an analyst report? I've got a bonus coming up that's going to make me like $10 billion, which he does. I mean, Elon Musk is going to get like a $10 billion bonus because of the price of Tesla right now. And because he hit his targets, he hit the 420 number that he predicted way back when, which triggers a whole bunch of stuff in his contracts. So he says to this guy, you know, obviously it's worth his while. And this guy knows that Elon Musk has 1,000 different ways of paying him back, like flying him out to his island, or sending his kids on a vacation, or putting up a scholarship fund for his niece. There's a million ways that rich guys can pay you back that don't look like paying you back. Not to mention the trading information, all kinds of other stuff that can happen. And all in very subtle ways. This is why they all golf, by the way. Even guys who don't like golf, you go to the golf course because why are you on the golf course? Because you're in the middle of nowhere. No one's listening and no one's watching. They don't know what you're saying to each other. That's how you do deals. This is why all these rich people pay all this money to be in golf courses, because you can't be bugged. That's the point. The whole point of a golf course is to conduct private business. You have an excuse to get together that when they subpoena you in court and they say, did you have a conversation with so-and-so about such and such a thing? No, we were playing golf. We talked about sports. You know, if you made a meeting and you sat in his office for 2 hours, it's kind of hard to say you went there to talk about sports. But if you all got together at a golf club somewhere, first of all, nobody probably even knows it happened because you just write golf. You don't write with who. And you go out and you have your meetings. That's how meetings get done. That's how everything gets done. There's that, and there's gyms. Gyms is another great place, like club gyms, tennis clubs, anywhere where there's locker rooms or places where guys can sit down and talk and have private conversations. Golf is hugely popular. And this is one of the reasons, by the way, that women are excluded from the workforce, from management like that. It's not the same thing. They don't tend to be the golf people. They don't tend to be the club people, and they get excluded from these meetings. That's why they can't rise. Because you don't have to. I mean, if you're a CEO, though, you have a lot of these kind of meetings. I've been to these meetings. I'm not that kind of person at all. I've been to those kind of meetings just because you get invited to them. You know, as a consultant and as a partner in certain ventures and so on and so forth, people are like, oh, let's meet here. And inevitably, if somebody says, let's meet at a club, you end up talking about stuff that probably nobody wants to have in writing somewhere else. But anyway, so when I say something's fixed, that's what I mean. I don't mean Elon Musk is running around handing out $1,000 bills to analysts or anything like that. I mean that Elon Musk calls in a couple of favors, and he calls a guy at a ratings agency and says, he goes, I could really use a positive report right now. He goes, gosh, when are you guys going to make a report on my company? And the guy said, coded language. And the guy will say, oh, we're scheduled for this. And he says, oh, damn, I would really like to see something before the quarter, because I know you guys like us, and we have this big thing coming up that I'm going to raise some more cash. And the guy's like, oh, don't worry. He goes, let me make a few calls and see what I can do. That guy then turns around, he calls 3 guys, and this is no skin off his back, because it's like a 2-second favor. He calls 3 of his analysts, says, write me a report. Those analysts knock themselves out trying to write the most positive thing they can on Tesla. The guy takes it, he publishes it, boom. That's how you raise the ratings. I mean, have you noticed how many reports are coming out on Tesla from analysts, and each one more bullish than the last? It's insane. It's an irrational thing going on. But you can't stop it. And Elon Musk, of course, he's like Donald Trump, right? He tests. He sees how far he can go. He tested the Twitter stuff. He saw how far he could push the SEC before they push back. Now he knows how far he can push the SEC before they push back, and he's now cruising along just under that radar all the time. He said, "You tell me what I can and can't do," and he can. The other thing is he can bring $20 million worth of lawyers with him when he goes in to see the SEC, and they're like, "You tell us exactly what we can and can't do, and from now on we will stay in that exact boundary." And that's what he does now. He plays the exact edge of the boundary where he's allowed to play, and he pushes it to the limit every single day, and he's manipulating the crap out of that stock, allegedly. Because I don't want to talk to his $20 million worth of lawyers. So Brendan says, do I think Apple can take off like Tesla? I don't think so, because I don't think Tim Cook would engage in this kind of activity. This is just a hype game. And Apple has as much reason to go off like Tesla. Now, the thing about Apple, if you're worried about Apple taking off like Tesla, the thing about Apple, though, is it's so freaking undervalued compared to Tesla and other things that when they start going stratospheric, if it starts to become a dot-com bubble sort of thing, what was that? How do I have this chart twice? I somehow opened that chart as a separate instance. I don't know how I did that. So Apple went from 2 months. Apple's up 50% in since September. So Tesla's up 140%. I think the number was since October. So they're not. It's not too far behind. But the thing is now, if this is like 1999 and Tesla starts going up like this and goes to 1,000 and goes up another 100%, and Netflix goes up 100%, whatever goes up, and Amazon goes up 100%, if all these guys go up like crazy, then as a bargain hunter who feels left out, I'm going to have to go to Apple. I wouldn't ordinarily want to go to Apple at this price. What happened? 1.4 trillion dollars. Oh my God, that's so funny. Okay. They added $700 billion in market cap since September. Okay. No, I'm sorry. They didn't go up 100%, did they? Apple is not up 100%. Let's try this again. Apple, 50%. I'm sorry. So if they're at 1.4 trillion now, they were at 9, basically. So they've added 500, only 500 billion. They've added $500 billion in market cap since September. It's just funny. I mean, it's just completely, utterly irrational. Okay. Anyway, all right, let's try to have a conversation about this rationally. So, do I think Apple should have added $500 billion? Okay, let's see. 50 billion, 60 billion, 55 billion, 56 billion, maybe 70, 60 billion next year. So next year, maybe they'll make a bit more money than they made in 2018. Okay. We're not even talking about what they were in 2018. I'm sure they were much lower. I don't really care. So in 2018, they were probably much less. But anyway, so the question is this $3 billion worth $500 billion in market cap? Is this $3 billion in earnings worth $500 billion? Don't forget about what Apple is worth now, which is 1.4 trillion, and $60 billion is 25%. So basically, they're trading at 25 times earnings. It's not horrifying. It's not terrible. It's just not exciting. So they're actually saying Ford PE 23. They're saying. This is what it says. Look at the industry. It's ranked in the industry. PE ratio is ranked 23rd out of 30. Wait, what? What does that mean? Apple's PE is ranked. Is the PE 23? Yeah, I guess it is. It's just a coincidence. So Apple's PE ratio is ranked 23 out of 30. What does it mean out of 30? In their sector. And Apple's PE is ranked 2,000 out of 3,000. I think that means it's one of the lowest. I don't know. I never use that. Anyway, the PE is 23. Let's worry about that. I was just curious what that was. 23 is not great. It's not terrible. Apple's historical PE is more like 15. And that's what happened, though. It's not about earnings. You're just paying more money for the same earnings. Now, you can have all this positive stuff about the sales cycle and whatever. Everyone's looking at 5G. And look, they made $50 billion back in 2015 too, and the stock was like, 1/4 of what it is now. The 5G phones are going to maintain their market dominance, but of course, it's a big investment cycle on 5G too. That's going to start paying off in 2021. That's why they jumped from 56 to 62, a 10% increase in overall profit. That's pretty freaking good. Sure, that's good. Do I like Apple for the long term? Of course I like Apple for the long term. But can Apple go and add another trillion dollars, and they only have to go up 60% from here? to get to $1 trillion. They don't have to double. They have to go up 60% to add another $1 trillion in market cap, to add an entire Microsoft, to add an entire Exxon, to add an entire Netflix or whoever the hell else is on Google, to add an entire Google. That's a good example. Because you think of that. Apple can add another entire Google by going up 60%. It still would be a complete bargain compared to Tesla. Oh, look, position in market first. First. No, that's the killer. Here's the funniest thing about it. There are only 5,000 stocks left. That's crazy. Look at the value. See the value slipped to 24? The value dropped 3.37 over the last 20 days. I don't know what value means exactly. Again, I don't know what all these things are, but it's whatever. The value is 24. It used to be higher. I know that. If this is out of 100, that's pretty surprising, actually. But quality, 93, momentum, 98, stock rank, 90, all good. Everything about this is good generally, except for the value. It just slipped tremendously. Position in the market, first. I agree with that. Best. There's no better stock in the world than Apple. Even at this price, I still would rather have Apple. If I have to put a gun to my head and say you can only have one stock for the next 10 years, I still want Apple. So, I mean, the question is, can it go up? Sure, it can go up, because if everything else, if the rest of the market has a PE of 40, then Apple's 25 PE seems kind of stupidly cheap. And if I'm forced to buy stuff as a fund manager, or if you guys saying, oh, what are we going to buy? What are we going to buy? What can we get in this rally? We're missing the rally. What do we do with the cash? What do we put it into? I'm going to end up saying, freaking Apple then. I got to pick something that I'm going to pay 30 times earnings for. So I end up picking Apple, along with all the other idiots who are paying $2 trillion for the company. Is it right? No. But what I think more likely to happen, though, is you're going to see Apple fall back below 300 on earnings, which are coming up pretty soon. I think maybe next week. Because it's just, there's not enough. There's nothing to justify from last quarter, from their last earnings, which were, I guess they were probably around here, October something, right? So from back here to here, what did they really do to justify this move? $100 increase in the price. What did they do? What are you paying for $400-500 billion? What's changed from the last report that justifies paying $500 billion more for the company? It's not nothing. Everybody treats it like these are just numbers on paper, but it's not numbers on paper. This is what you're paying in value for this stock. You're getting a very, very teeny tiny piece of the company, a billionth of the company, for $600, or I'm sorry, for $320. So that's 1 billionth of Apple, or less. I don't know. It seems like they have more shares now. To say how many shares they have? Well, if they're 1 point, they must have 2 trillion shares. Wait, no, 4. Shit. Yahoo. Can they have 4 trillion shares? That seems wrong. Oh, they did that split. That's why. I forgot about that. Statistics. Yeah, 4 billion shares. They have 4 billion shares. I forgot about the split. So you're buying 1/4 billionth of the company for $300 and something. Is that worth it? Do you know what a billionth of something is? It's not really conceivable, is it? I mean, if you think about, like, I have a green tea bottle in my hand, right? And it's 16.9 ounces. So a tenth of that's an ounce. 100th of that is a tenth of an ounce, or almost 2/10 of an ounce, let's say. 1,000th is 0.2 tenths. A millionth is, 3 more zeros and another 0 and 2 and a 2. That's only to get to a millionth. To get to a billionth, you got to write zeros halfway across the bottle just to show how little you actually have, and the actual amount of it would be I think atomic in scale. Like an atom of this bottle maybe would be that much. And one atom of plastic that's polluting the ocean is what I would own. So, your position is nothing in this company. Your rewards are only whether or not they can find somebody who's going to give you $2 billion, who's going to pay $600 down the road at some point for the same amount. And the justification is the same justification it was 2 years ago, 3 years ago, 4 years ago, when Apple was nowhere near this price. What? Oh, because when you're at max, it screws it up. Look at this thing. Too funny. Look, they again, in 2015, 233 billion in sales, 53 billion in profit. This year, 276 billion in sales, 56 billion in profit. Call it 57. That's still not even up 10% from where it was in 2015. It's 20% more revenue, 10% more profit on the bottom line. How much more are they asking you to pay? In 2015, Apple was at a peak 126, 130. At a trough, $100. You're paying 3 times, 2.5, 3 times more for essentially 10% more earnings. So 1.4 trillion, you're paying $1 trillion for this additional $4 billion in earnings. So that's what you have to look at. You're paying 250 times the net gain in earnings. That's the kind of madness that is currently on the market. Apple is a huge portion of the entire move in the indexes. Apple's driving the all-time highs right now. And we've often said in prior times that Apple is often used to mask the overall sell-off on the NASDAQ. So in other words, right now, the indexes have pulled back quite a bit from this morning's excitement. People are selling. Apple is still up. Apple's going to have earnings next week. Maybe they'll push it up even higher just because they got to cover the selling of the rest of the NASDAQ. But you can buy Apple. You can add 5% to Apple, and that's going to add 1% to the NASDAQ. That means you could sell off the entire rest of the NASDAQ 1%. Every other stock in the NASDAQ, you can sell off 1%, and you'll keep the NASDAQ flat by driving Apple up 5%. So what does that mean? It means that the people who are the top funds who own a large portion of these stocks can reduce their exposure and mask it by buying more of a huge bargain stock like Apple cheaply. And of course, Tesla, they do it with Tesla, they do it with Netflix, they do it with Amazon. Now, they can do that for a long time. They can manipulate these stocks higher. And I say this back in 2007, I explained this to people too, because this is what happened in 1999. When the big guys want to get out, what they do is with one hand, they buy up the leading indicators of the market. And with the other hand, they sell off all the small shit that they would have trouble unloading. You can always unload Apple. You can't always unload all these little crappy, stupid stocks that they paid 100 times earnings for. But Apple, you'll always be able to unload it. And if you don't unload it, you just got to wait a couple of years. They'll start earning, they'll earn more money and start justifying their market cap. You'll be stuck with them for a while, but nobody's going to shoot you because you're stuck with Apple. They will shoot you if you paid, if a fuel cell, if you paid $3 for fuel cell and it's back to 1 and you're the idiot that owns 500 million shares of fuel cell, they're like, well, what the hell's wrong with you? But you don't have to do that because you can sell all those fuel cell shares while you're using Apple to push up the rest of the NASDAQ. That's what goes on. You know, there's so much of this stuff here. Tesla is now over $100 billion. All this gets added to the NASDAQ, but it's all fake. It's all just so fake. Because even Apple, which has a really, really solid amount of volume, okay, they trade 16 million shares. The average volume is 27 million. All right, so 27 million shares. So every day, Apple trades 27 million shares. So 27 million times 320, 8 billion. So that's 8.6 billion shares of stock is traded per day of Apple stock. That's out of 4 trillion, sorry. So 4,000 billion divided by 8.6. So 1/465th. Okay, because I'm sorry. No, wait, no, did that wrong. It's not about how many shares there are. It's how much money Apple is worth. That's the point. So it's 1/4/1400 divided by 8.6, 162. So so every day, 1/162nd of Apple, which is 0.5%, let's say, or about. So 0.5% of Apple is actually traded on a daily basis. But in reality, most of it's traded flat, right? I mean, somebody buys it, somebody sells it. It's basically the same price all day long. It's only the marginal 10% that moves the price. So in other words, if it's 10% more buyers than sellers at the end of the day, if it's 10% more sellers than buyers, that's what's going to move the stock. It's the amount, is like when there's an imbalance of buyers to sellers, but mostly it's just a balance of buyers and sellers. So the move is made based on 10% of this. So 1/1600th of the stock of the purchases is moving it, or out of 8.6 billion, let's say $800 million is what you would need to influence Apple's stock up and down in the course of a day. So you can put, and there are hedge funds that have trillions of dollars. Okay, Blackstone's got, is it Blackstone or BlackRock? BlackRock. BlackRock's got 4 trillion under management. So you think they can't, like, add and subtract Apple and do whatever they want with it? Of course they can. They can bounce it like a basketball if they want to. Jim Cramer, there's a video of Jim Cramer, which I've put up many times in member chat, where he explains exactly how you manipulate a stock, how a hedge fund manipulates a big stock. And he said, that's what you do. He goes, if you want to keep your job as a hedge fund manager, this is what you do. Not some people do this and some people don't. He's like, this is what you do. You sit there and you manipulate the stocks and you alter the closing prices to suit your needs. That's how you that's how you get an extra 0.5 point here and there. And big funds can do that. And he claims that they all do it all the time. Now, I don't know if that's true, but I know a lot of people who do. So it's definitely partially true. And he had a really good explanation of saying what he was doing. But the bottom line is, because you don't realize how little it takes. It's not about $8 billion of Apple being traded on a daily basis. It's about the 800 million, the $1 billion of Apple that you can just put in a buy order and put in a sell order, and you can change the stock. And by the way, that's over a whole day. So that means at any given time, if you want to goose Apple's price, you just need about $100 million to move. You're talking about moving a $1.4 trillion company with $100 million. That's the craziness of the stock. But that's true. And now if you imagine, because the way stocks work, if you let's say you live in a development with 1,000 homes, right? And they're all pretty much the same. It's like a cookie cutter Florida kind of development, which frankly is all we have around here. And all the homes are worth about the same. They're all worth $500,000, let's say. Okay. If I decide that one of the homes is perfect for me and it's for sale right now and it's near the clubhouse or whatever, blah, 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 and I say to the guy, I'm going to pay you $750,000 for that home because he doesn't really want to sell it. And there's no other home I want that much, or nobody else happens to be selling. I go to one guy and I say, I'm not going to give you 500,000. I'm going to give you 750,000. Why? Because the 750 is nothing to me. So I'll do it. It's like it's an inconsequential amount of money. I'm happy to spend it. So now I do that, and in a home transaction, it wouldn't really make the whole neighborhood go up to 750 each because I'm just one guy. And it's a one-time transaction, and it would be basically ignored by the surveyors. It would be thrown out as an outlying comp. But if over time it became a pattern, then the home prices would start to rise. Now, what I'm saying, though, is because of stocks and the way they are, at the close, if I'm the guy who comes in and buys one house for $750,000, that neighborhood, which was $500 million worth of homes, 1,000 homes at $500 a price, at the close, that neighborhood would then be valued at $750 million. It would have gained $250 million in value overnight just because I bought one home for $750,000. I would have affected the price of the development by $250 million. And did it cost me $750? No, it only cost me the $250 I overpaid. So now imagine my $250,000 adds $250 million of value to all those homes, right? Now, let's say that I knew I was going to do that, and I bought 10 of those homes for $500,000 over the last couple of weeks. And then I come in and take $250,000 extra and buy one more home for $750. Now, the next day, this wouldn't work in a home because it takes too long to sell them, but in stocks, the next morning, I could dump my 10 homes on the market at the opening price of $750,000 or close to it. I don't really give a crap as long as I get more than $500,000. So every home I sell at 750, let's say I get 700 and 650 and 6 and 5 and 645 and 6 and 545 and 550 and 500 and 520. So let's say I get that much extra, it works out to maybe a few $100,000 extra dollars. So it doesn't seem like much because I spent $250, but I make $300 on the other 10 homes that I'm selling, almost $30,000 each more than they were. I'm going to certainly clear that out of the first 10 homes I sell. And now I've made a profit of $50,000. Okay, but now that sounds like, so what? That's not that big of a deal, but it is because I can do that with $1 billion and make a profit of several $100 million. And yeah, I got to move $10 billion back and forth and around, but I'm still going to make several $100 million. And if I do that 10 times a year, I'm going to make a couple of $1 billion on my $10 billion. And a couple of $1 billion on $10 billion is good money. And all I've done is manipulated a major stock that it wouldn't kill me to get stuck with. That happens all the time, all the time. That's how the market really works. That's why Goldman Sachs has 0 losing days trading. That's why JP Morgan has 0 out of 200 something days trading. They have 0 losing days. Because at the end of the day, they're going to make damn sure that they won every day. And nobody checks it out. Nobody investigates it. They all go, people want to see statistics year after year after year. And you go, oh, that's pretty good. They've never lost. No matter what they buy every day, no matter what the market conditions are, they've never lost. JP Morgan profitable trading days. Crush earnings 202 post record. Oh, they made big losses. When was that? 2018. Oh well, there's no like set number. I'm telling you though, when you read the reports, you'll see that like they're literally zero losing days. It's just the silliest thing in the world. And you're like, how is that possible? How can you be right every single day? How can you possibly never be wrong in your positions? Well, and they say, well, we're really good at this hedging thing. It's like, no, you're not. Nobody's that good. You know, Trump says something, the market drops 10% in the last 5 minutes of the day, and you knew that, or you were on top of it. It's bullshit. Or something positive happens, whatever. It doesn't matter which way it goes. It's like, how can you possibly be in that position? And nobody doesn't get investigated again because they push and they push and they find out exactly how far they can go before the SEC blows a whistle. The SEC doesn't do anything. They just get away with all this crap. You know, but it doesn't matter. It doesn't matter if the market's manipulated as long as we understand that it's manipulated and we can play along. But in this particular case, though, you don't know how far people are going to push this thing. But there are signs right now because look at the market. I mean, the market's dipping down still. What are these things? It's 5 minutes. Oh, it's magnified. There you go. That looks better. Unmagnify it. So that's just a couple of days charts now. So, you know, everything's been fading out basically since we started the webinar. I guess maybe because I'm being negative. You guys are all selling. But, you know, so we're fading back out. We're giving up all those big gains today. I mean, we were, you know, look, we were at 29.3 when in pre-market. Don't forget, we were here yesterday. So we were 29.1, basically 29.1. We gained 200 points. Then we lost the 200 points over here. Now we gained 100 points, or more than 100 points. Now we're coming back down. We're going to be back down to where we were yesterday. Because it's all bullshit. But the point is, what's being held up? What's not going down? Apple. Apple's up 1%. Why is Apple up 1%? So you don't know that that's happening. That's keeping this from looking bad. Apple's up 3 points. That's adding 24 points to the Dow. The Dow's up 17. It would be red if Apple wasn't up 3 points. Apple's adding to the S&P. Maybe 0.25%. The S&P's up 0.25%. Okay? This would not look very good if Apple wasn't up today. This is how you mask the entire thing. You keep jacking up Apple. Jack up Apple, jack up Apple. Went down, jack it back up, jack it up again. Just keep jacking up Apple. And you can do that because it was been undervalued for so long that it takes it from you can day after day after day after day push it higher to a point. But the point is going to be, again, when you're starting to say, well, if I have to add 10% more to Apple, it's $150 million. Billions, $150 billion has to be added to Apple to get it up another 10%. At a certain point, you can't do it. At a certain point, you physically can't move the stock anymore. The top 5 stocks on the NASDAQ are now $4 trillion. So when you want to make Apple and Amazon and Facebook and Google and Microsoft go higher, you need to move $400 billion every 10%. Where is this coming from? What is this money? It's clearly not supportable, and that's why it's such a dangerous thing when you get to these kind of levels in a market. That's why it's a bubble. It pops like a balloon. There's no support for this. There's no actual money coming in. It's just like that last house I bought that I bought. One guy buys one house for $750,000, and you think the neighborhood gained $250 billion in value. $250 million in value. That's bullshit. That's insane logic. And you understand that with the houses, it obviously can't possibly work that way. It also can't possibly work that way with the stock. But the problem is with the houses, you understand it's a slow motion process. So you can think very clearly about the actual value and the mechanics of where are these buyers going to come from, what idiots are going to jump in and start paying $750 instead of $5 just because one guy paid $750, who would do such a thing, blah, blah, blah. That's all true with the stock market too. Only you can't tell because it's going to, in the home business, you know it's going to take months of people going back and forth and going to mortgage companies, and the mortgage company says no, and so on and so forth. In the stock market, you don't see it. But eventually, an accountant gets involved, and lawyers get involved, and people start looking at things, and then companies collapse, and then they have to get properly valued in bankruptcy courts and things like that. Lawsuits happen, and things have to get valued properly. it's just a very slow grind. Sometimes a big event happens that makes everybody wake up and say, oh my God, this can't be sustainable. Oh, there goes sustainable again. It can't be sustainable, but it's not at a speed that you're used to dealing with things. It doesn't unfold in a way that you're going to be able to comfortably get your head around what's happening in the market. It takes a long time compared to the attention span of a trader, which is not even, most people are like staring at intraday charts and things like that. This is something that you're only going to see like on big monthly screens. So how do we get on that topic? Oh, I remember because Brendan asked me a question. That's right, Brendan. It's all your fault. Because now we only have 10 minutes left in the webinar. Wow, that really went crazy. All right. So anyhow, so good instincts yesterday this morning, good instincts to short. But that was it why? Because when the market was up for no reason, I said, let's short these levels. Because we were there for no reason. If we're there for no reason, here, I'm going to refresh. Because here's where we were in the morning, right? 9244. And I said, well, I'm reading the news. You guys know I read the news constantly. So I'm like looking at the news. I'm looking at the market. I'm looking at what's going on. I'm watching the impeachment stuff. I'm paying attention to everything that's going on in the world, the Chinese disease, all that stuff. And I'm saying, I don't see where this is justified. Why would this be happening? All right. So here we are later. Watch this chart. Oh, look what happened. Went the other way. That's where this futures money comes from. What did I do with the NASDAQ? I didn't make much on the NASDAQ, I don't think. Why didn't I make much on the NASDAQ? Because of Apple. That's why I made the least money on the NASDAQ, because they're using Apple to prop it up. But here good money and here good money. It's an easy call. If it went up for no reason, it's very likely to go down for the same no reason. And then God forbid there's a reason, it can go flying down. Like yesterday, like we also made some really good money yesterday with the stupid disease outbreak thing. And I said, meanwhile, I was doubling long on natural gas. That's not working, but it was 190. It's 191 now. So what can you do? All right. Anyway, so that's that. And I guess we'll go over the portfolios next week. So we're not going to go over them this week because that would take a lot longer than 10 minutes. So we'll go over all our positions and what we're doing and so on and so forth. But we did the dividend portfolio, right? And the butterfly we looked at, the earnings portfolio is, these haven't been adjusted though, 7.5%. Hemboka, 9.2, not bad. Money Talk we looked at, short term, probably getting killed. 2.3. Why? These sons of bitches. Although I think we made an adjustment, but at the moment, I mean, that's just sucked up all the money from that portfolio. Totally insane. So I had to put in the adjustments, but we lost a ton of money in this portfolio from that. And it's an unrealized loss, obviously. So but we will take that, we will take the loss and do exactly what we were just talking about. Unfortunately, we sold the freaking 400 calls. And we only sold them for $40. So we got a massive $90,000, we got a $70,000 loss on those. We did roll them, but we're going to have a loss on the roll too. So I don't think it's going to even be better. We just got totally jammed out because of this freaking play. I'm so pissed. So we will see where we are next week. We did make adjustments, so I don't remember what they were. They didn't help though, because Tesla kept going up. So I don't think I was that clever. What was that, Friday? Or it would have been, I think it was Friday on the STP. Let's see how smart I was. TSLA. Oh, here we go. Short-term portfolio. So now, and it's a whole mess. We have to break up. We were 44%, so that's $40,000 basically. What did we decide to do with Tesla? transfer it to the STP. This STP is now the long-term portfolio. We're going to absorb the loss here. In the new LTP, we can afford it, so we're cashing out and making a fresh position in the new STP, which will be, wow, so that's good because we took the loss, and the loss at the time was only $41,000, and now it's shit. Where is it now? 69,000. So $28,000 worse since we cashed it out. That's awful. And we sold 5 of the 300 puts. Oh, it's pretty much what I just said, isn't it? Oh, it's so funny. I'm so consistent. We sold 5 of the 2022 300 puts. I felt went further out, and we sold 5 of the June 550 calls at 49, but those are going to get crushed now too. So the June 550s, but at least we have a better base to work off of. So the June 550s now are $86. Look at that. That sucks. And they were $50. So now we're down 36. So we're down 15, 20,000 bucks on those already. Offset a little bit by the short puts, but really nowhere near enough. So our next step would be to do what we just talked about before, is we would now sell more June puts, roll the calls higher, and hopefully one day Tesla is going to stop going up. Because if it doesn't, we're going to be in big, big trouble. And we will have to realize those losses and just start again and just say, hey, didn't make money, start again. The worst thing you can do is put yourself in a position where you actually impacted the portfolio. The portfolio was way ahead, so we gambled on it. So far, that gamble is killing us. So we'll see what happens. But that's, like I said, that's how you blow your gains, right? Because if you have gains and then you keep gambling, you can blow your gains. And that's basically what happened. We had $44,000 worth of gains, but we have now blown them effectively because we kept gambling. All right, we could have just cut the position and given up. But, you know, honestly, though, because we cut it and we started a new position, we only lost, instead of losing 28,000, we lost maybe 20,000 or 15,000. That helped a little bit, but still we lost half of our profits in the portfolio, disappeared on this position so far. Very, very unfortunate. And so now, you know, so we went off from basically having a spectacular year, could have closed the portfolio and been done with it and been up 50% for the year. And now we're not there anymore. So now he's got to work back out of it and do it again. That's all. All right. So next week will be interesting because we'll see where this thing ends up. And I think Tesla's earnings will be by then, right? When do they have earnings? TSLA. Nope, not until the 29th. Oh, that is next week. Oh my God, it's gonna be next week on at night, and then we'll find out what happens. Todd says, I had a good trade buying the $20 SQQ puts for $150. When the reverse split happened, sold last week for $5. Wow, very nice. Robin says, will the bond sale on NLY affect the stock? I don't think so. I mean, I don't, it wouldn't to me because I like it if they're going to sell bonds. It's better than taking on regular debt. So I don't think it's going to make a big difference. I mean, it's in some way, to function as a company, they got to raise money, right? They need cash if they want to expand their business base. They already are kind of beaten up though. When do they announce it? Announces common stock dividend. Okay, it's not a recent, I don't see any recent announcement of it, but anyway, so I don't think there's anything wrong with the bond sale. It's a pretty normal way of doing business for these guys. I mean, they have to, if they float a bond, they have a fixed rate of interest, then they have to lend out and make more interest on that than they're paying on the bonds, and the spread is their profit. So I don't think that's a bad thing at all. All right, well, we're going to do it all again next week. We're going to have some very exciting, we'll see what Tesla's holding up next week, or if it's still up in the whatever the hell it is. Where is it? 560, pull back a lot. Wow. I mean, still way up there, but 560 it was almost 590 before. So we shall see what happens, and we'll find out next week. And by then I'll certainly have all the portfolios properly updated. All right. So thanks for coming, guys, and have a wonderful, wonderful week. We'll do it again and see you then. Bye.